Hello, we're going to look at the next case, which is on materiality. That's one of the 5 primary principles that's in that original PDF. Revenue recognition, expense recognition, or matching principle, materiality, and then 2 we're not going to do a case on, which is consistency and conservatism. So this one is the 3rd of 5, which deals with materiality, and something you're going to encounter in your career. It's a good case here on Auto Parts Incorporated about a change from where they've been expensing spare parts, meaning it goes to the income statement every month, every quarter, every year, and now they're looking at actually making it an asset or an inventory item, which theoretically is probably better, but the question here is, what is material as far as, is it significant? Because that's another word synonymous with materiality. Is it significant enough to actually disclose what it is you're doing as a company? And you can't just start making, because this isn't a change in accounting principle. You can't just start making a change in accounting principle from really the cash basis of expensing it, and now going to the accrual basis of putting this on your books and then expensing it out of inventory as an asset onto your income statement as it's incurred or as it's used. That's a key part of accrual basis accounting, is actually matching those expenses in the period in which the revenue is being earned. But up till now, this Auto Parts Incorporated considers it's immaterial to, first of all, just go ahead and expense it, and second of all, here, now that it's going to be on your books, is it material enough to disclose? So there's really a couple questions there on materialism. So let me share that case here. Go back to the beginning, make a couple comments here. Now, I've actually highlighted there in yellow, materiality. What's the estimate for materiality, which is quantitative, that you're going to calculate? And I've given you a link for that, give you some idea. And what are some qualitative issues that affect materiality estimates? But what's happened here is this company is expanding its planned and fixed asset spending, which is obviously an asset, but they're also going to significantly increase the level of tooling inventory. Now you think, what's tooling inventory? Tooling inventory is typically expense when it's purchased. We did that at Exide. We did that at Lear. Even though we had $1 million of spare parts inventory at Exide, we expense that when we purchase it, even though it might be used in future months or maybe even future years. We still had to control that as inventory, even though it wasn't on our books as inventory. It was expense when it was incurred. So you see 2 things going on there. If you're expensing it like we were doing, it's going straight to your income statement. But it wasn't material enough on a $2.3 billion company. It just wasn't material enough how much you were buying each month to replenish that. So we just expensed it. We did track it and control it because we didn't want theft to occur. And that was something our external auditors were always asking us about, how we managed our inventory, even though it wasn't inventory, it was already expensed. But here, this company, they give you some numbers here, which I've put in a spreadsheet we'll look at here in a minute. Well, a legal pad, it's not really a spreadsheet, but put in spreadsheet form on a legal pad page to show you some of these numbers. But this significant levels of inventory, this company is wanting to, well, let's just go ahead and go down here and look at it. See if I can rotate that. There we go. What I've done is taken the information from this case for you, something that you should be able to do yourself, but I went ahead and did it to make it a little bit easier for me to explain this case. But what they have here on your income statement, $650,000 of $175,000 of which actually would have been put into 2005's tooling expense. If you can read through that, you'll see what I'm referring to. They also give you some other numbers, 60 million for total revenue and pre-tax income of 5 million. All right. It also says on the balance sheet, there was no inventory in 2004. See, that's what they've changed. Now they, based on the case, said they've grown to put $300,000 as inventory instead of being expensed. Correct? So that's what they're saying. It's 175 really would have been down here. But in fact, if it had been down here, it's going to show up in 2005 as expense. So you can see how their amount of tooling expenses really accelerated because of the increase in property, plant, and equipment. Anytime you have more property, plant, equipment, machinery, equipment, building infrastructure, anytime you have that kind of investment, you're going to have more expense down the road. Now, obviously, during the first few months, maybe a year, you might be under some type of warranty, but there's a lot of ongoing routine maintenance that you have to put into the system to take care of that. And that's what this tooling expense is, to support your plant assets. And because they've got so much more plant asset acquisitions and so forth, naturally your tooling expense is going to be more. So that's why they're converting this to inventory is $300,000. And again, that 175 would have been right here where the zero is, meaning it would have been expensed the following year. And then they also give you another number here. Total assets are 47 million. So the question is this material change? This is a change in principle. You might want to research that and use that in talking about your paper response here for materiality. This is a change in principle, accounting principle. You can Google search that, however you want to look that up, to see what happens with the change in principle. You actually go back and restate the prior year, right? Which would have been 175, which is then going to be expense. That's a part of that $1 million. All right. But the 300,000 is going to go on your books as an asset. If they had not changed this principle, this 300,000 would have been up here in the 1 million. So you would have $1.3 million of expense. So keep that in mind. So that's what's going on in this case. I thought I'd just kind of talk through this. Let's see, let me go back up here and look at the case again. You know, all those numbers are coming straight out of what you're looking at here. So looking at the questions here, I would erase number 2. It's not misnumbered, 1, 3, and 4. I want you to answer these questions in your case response. Describe whether you agree that capitalization of tooling inventory is preferable method of accounting for auto parts, meaning should they actually capitalize this? What do you think? I mean, you can justify probably both yes and no, that you should, and no, yes, that you should do that, and no, that you shouldn't. And it says in question 3, ignore the auditor side of this. In general, how do auditors develop an estimate? How would you develop an estimate of planning materiality? What do you think should go into that for auto parts? And what would your preliminary estimate be? Now, I've also given you a link that you can look at here. Let me see if I can share that. I think I was already on the screen I need to be on. Yeah, materiality thresholds. I've given you a link there to a very short article about materiality. And so you can read through that and see what it says about what percentages you might use for something like that and how you might calculate that. There's actually a pronouncement out there, SAB 99. If you want to do a search on that and read what it has to say about what percentages would you use to quantify whether that 300,000 is material or not. right? What I've got down here at the bottom, that's the number. Is that material? What would you base that on? Is it based on this pre-tax income? Is it based on revenue? Is it based on total assets? Do a little bit of reading on that. You'll find out the answer. You're not going to find it in this. This is very generic, very high level. Good book, very high level. You're definitely not going to see it in Accounting Made Simple. Because here you're getting into the guts of decisions you have to make as a general manager, as a plant manager, as someone involved with managing assets. Yes, you have a CFO or corporate controller, but you need to know what's going on in making these changes. Again, this is a change in principle. And this is how much is going to be on your books that would have been up here in the $1 million. Again, going back up here to the top, to the questions. Then what are some qualitative factors that might impact your decision about the materiality of the accounting treatment and the related disclosure? Again, what are you doing here? You've got $300,000, and that would have been where? That would have been as an expense. So by adopting this change, you've actually increased your net income for 2005 by $300,000, haven't you? So what ramifications are there? What if they're paying bonuses based on net income? Well, they've just increased their net income by no other reason than they changed accounting principle, haven't they? So that's driving this. That would be a disclosure, right? That would be something that you would consider qualitatively. There's other items. I just thought I would throw that out there. That's the obvious one. But you've changed accounting principle. So do you need to go back and restate the last 3 years, probably, of net income by changing this standard, changing your inventory levels for the last 3 years, not just 2004, but going back to 2002, 2003, and 2004, as well as 2005. A lot of things you can talk about in your discussion in this paper. I want you to come away with a very good understanding of what materiality is about. Why is that one of your 5 primary accounting principles for GAAP, right? Generally accepted accounting principles. Again, if you're a publicly traded company, large company, you have to follow that. You have to follow the accrual basis of accounting. But you can, even though that sounds like cash basis accounting, which it is, you can have cash basis accounting with inventory, that tool crib inventory being expensed. There's not a problem with that. Like I said, ours was about $1 million in that side. We were publicly traded. We never put it on the books. So what's driving? Why would you want to put it on the books? Are you just trying to be better about having stuff on your books, even though it might be immaterial? Or are you trying to, I guess, influence your net income that you're paying bonuses out of? And these, if it's not bonuses, maybe your net income is driving your key stakeholders or your key business leaders in your company to their stock options based on increases in net income, which is increases in earnings per share. It might drive your stock price higher. But if you disclose that you've got more income just because of a change in accounting principle, then your analysts are going to see that and they're going to communicate that to potential shareholders. A lot of stuff going on here. So it's a good case and good luck with it.